Hi friends, today we will see how to check company's ability to earn profits from its sales or operation, balance sheet assets or from shareholders equity. Also we will see how to predict the company's financial ability to check whether the company will sustain in future or not. Towards the end I will give you an important pro tip so that you can check yourself whether to buy a particular stock or not through a dipstick analysis method. So stay tuned till the end. Don't miss out the important opportunity.
Hi friends, welcome to a brand new segment of FinveStocks, Friday Basics, which will give you good insight about Indian equity market. My sincere effort in this segment is to create awareness to all in simple language. This series will be arranged in such a way so as to understand everyone who are beginners. Please share this video to all those who wish to learn, understand and participate in stock market. Please don't forget to subscribe and click the bell button to get the notifications of upcoming knowledge-packed videos on personal finance and stock market. Welcome back to FinveStocks, where we make everyone understand the basics of money management. Before going into this video, make sure you watch earlier videos of this series, which is mentioned in the I button.
In our last video, that is Fundamental Analysis 4, we started with financial ratios. There we saw what are the different types of financial ratios and we concentrated mainly on valuation ratio. In today's video, we will see what is profitability ratio, how efficiently company is generating profits. That we will come to know through profitability ratio. Let's begin. So we will start with profitability ratio. Profitability ratio assesses a company's ability to earn profits from its operation, from its assets or from shareholders' equity. Hope you understand what is asset and what is shareholders equity. All these things we learned in our previous videos, that is mainly on balance sheet. Profitability ratios indicate how efficiently a company generates its profit and value for shareholders. So why it is so important? It will help business to identify growth opportunities and market trends. Finally, this will help in decision makers to see a more concrete picture of company as a whole. So for investors, how it will help? Yeah, the profitability ratio will help the investors to predict the financial stability of the company. It can tell you the company where you are invested is in a right path or not. So it is one of the important parameters one should look before going into investing in some company. So now we will see the profitability ratios into detail. Like what are the different type of profitability ratios and how it is useful to assess the ability of the company. So when you talk about profitability ratio, the most important ratios are, first one is net profit margin, which will show what is the margin on net profit. Then comes gross margin. Then other three ratios are return on assets, return on equity and return on capital employed. ROA, ROE and ROCE. These are the three most important ratios on profitability ratio. So let's see each one in detail. Before going into profitability ratio, we will understand book value, face value and market cap. There is always a confusion between book value and face value. So we will try to understand the difference using a simple example. Assume I started a company with 5 crore capital. The total capital of the company is 5 crore. This 5 crore is accumulated through various sources. I put 2 crore rupee. One of my friend give 50 lakh rupees and other friend give 1 crore and the third friend gives another 50 lakh rupees. So the total capital is around 5 crore rupees. So equity capital is 5 crore. That is cumulative sum of all the capital. Assume the total number of shares issued is 50 lakh shares. So face value we can derive from that. Face value is equity capital by shares issued. So total capital is 5 crore divided by 50 lakh shares. So the face value of this particular company is 10 rupees. Next comes book value. So if you are a first time investor, you can get confused between face value and book value. So one thing you should understand is face value is fixed and is not affected by market condition. The price of the face value is decided by the company itself. It is the nominal value of the stock at the time of issuing. It cannot be calculated as the face value is determined by the company. Book value is another concept which is closely related to face value and market value of shares. Book value means the value of share in the company's books. It is calculated by dividing the company's net worth or the difference between asset and its liabilities with the total number of shares issued. Or in other words, you can say book value is the stockholders' equity divided by total number of shares issued. So if you see in this example, book value per share is 15 crores, that is the shareholders' capital, divided by 50 lakhs, that is the total number of shares issued. So the book value is 30 rupees. Assume after some time the company got listed in BSE. So it listed with a current market price of 50. So that means it is listed with a premium of 20 rupees to the book value. So what is market capitalization? So market capitalization is the current price of particular stock multiplied by total number of shares. In this case, the current price is 50 rupees and the total issues of shares is 50 lakhs. So the market cap is 25 crore rupees. So now we will see profitability ratios in detail. So the various profitability ratios here we are going to discuss are net profit margin, gross profit margin, return on assets, return on equity and return on capital employed. So all these profitability ratios shows how efficiently a company generates profits and value for shareholders. Profitability ratios are used to predict the financial ability of the company. So now let's see each one by one. The first profitability ratio is net profit margin, also called PAT margin. It tells us how efficiently the company's profitability is. PAT margin tells us how profitable the company is at an overall level. So how to calculate the net profit margin? So net profit margin can be calculated from the profit and loss statement. So if in this example we can see revenue is around 10 lakhs and the net profit is 2 lakhs, which accounts for expenses, tax, depreciation, amortization, etc. So net profit margin is net profit divided by revenue. So here in this example it is 2 lakhs divided by 10 lakhs. It's approximately 20%. The next one is gross profit margin. The percent of revenue that is actually profit before adjusting for operational cost such as marketing, overhead and salaries is gross profit margin. How to calculate gross profit margin? Is the ratio of gross profit to sales. For example, here the revenue is 10 lakhs and gross profit is 4 lakhs. So gross profit margin is 4 lakhs by 10 lakhs, that is 40%. Next comes the EBITDA margin. EBITDA margin is EBITDA upon total sales. EBITDA margin tells us how efficient the company's operating model is. EBITDA margin tells us how profitable the company is at an operating level. So EBITDA is operating revenue minus operating expenses. That is total revenue minus other expenses minus total expenses minus finance cost. So EBITDA margin is EBITDA by operating revenue. For example, consider the example EBITDA is 250 crore and operating revenue is 2500 crore. So an EBITDA of 250 crore means the company has retained rupees 250 crore from its operating revenue of 2500 crores. So EBITDA margin shows the company spent 90% of its revenue towards its expenses and retained 10% of its revenue at the operating level for its operations. The company makes 10 rupees when 100 rupees operating revenue generated. The next one is ROA, return on assets. That means how much returns generating from its own assets. So this is the ability of a company to use its asset to create profit. So a well-managed company limits its investment in non-productive assets. ROA indicates management efficiency at deploying its assets to generate profits. By formula, ROA is net income upon total average assets. The only disadvantage in ROA is if the assets are funded by debts, it will not reveal the true situation. The next two profitability ratios, that is ROE and ROCE, are the most important profitability ratios out of the lot. ROE stands for return on equity. As the name suggests, return what we can expect from the equity is ROE, which will help the investors to assess the return of the shareholders' earnings for every unit of capital investment. It is the ability to generate profits from the shareholders' investment. It shows the efficiency of the company in terms of generating profits to its shareholders' fund. So higher the ROE, better is the company's position. So we should always aim company having an ROE of more than 15%. ROE by definition is then ratio of net income to average shareholders' equity. To understand return on equity in a better way, here we will see one example. Mr. A started business putting 1 lakh rupees from his pocket and he didn't take any debt. So debt is zero. So the total assets is 1 lakh rupees. So shareholders equity is 1 lakh rupees because assets should match with the liabilities. So profit generated assume is 25,000 rupees. So ROE after first year is 25,000 divided by 1 lakh rupees, that is 25%. Similarly, a company B started business by putting 50,000 own fund and parallelly he took a debt of 50,000. So here also asset is 1 lakh but the shareholders equity is only 50,000 rupees. Assume similar profit is making by the company B, the ROE will shoot up because ROE is 25,000 divided by 50,000, that is 50%. The higher the ROE is better, but here in this example, it is under the expense of debt. So that is not good. With an additional debt, the ROE will shoot up significantly high. A higher ROE is great, but certainly not at the cost of higher debt. So it is very risky as the finance cost will increase drastically. So from this example, one thing is clear. One should not blindly go with ROE numbers. Because with an additional debt, the ROE will shoot up significantly higher. A higher ROE is great, but certainly not with the cost of higher debt. So if the ROE is higher, you should deep dive into the financial and see whether this ROE percentage is genuinely because of equity or because of debt. So if the ROE is inflated because of debt, the solution for ROE is ROCE, which is return on capital employed. The basic difference between ROE and ROCE is in ROCE, debt is included. So what is ROCE? ROCE, return on capital employed, indicates the profitability of a company taking into consideration the overall capital it employs. By definition, ROCE is EBIT, earning before interest and taxes upon overall capital. The overall capital is nothing but debt plus equity. So ROCE, that is return on capital employed, by definition is earning before interest and tax upon total assets minus current liabilities. So you can get earnings before interest and tax from profit and loss statement and total assets minus current liabilities from balance sheet. So the ratio of these two will reflect what is the ROCE percentage. As suggested by Warren Buffett, both ROE and ROCE should be more than 20%. The closer the number is the better. So any divergence between these two is not a good sign to buy. So some important pro tip for ROCE and ROE. Never depend on either ROE or ROCE alone for measuring capital efficiency as they can give biased results. So use both in tandem. If ROE is greater than ROCE, it can be said that the balance sheet of the company is leveraged, as we saw in the last example. If ROCE is higher than ROE, then there is a chance that company has little or no debt on its book. So as an assignment, what you can do is you can pull out 3 or 4 companies and try to calculate all the profitability ratios from the numbers from the profit and loss statement and balance sheet. So for that purpose, you can use screener.in, wherein you will get all the profit and loss statement as well as balance sheet. So try to calculate each profitability ratios one by one. So maybe we will discuss in detail with some examples in the upcoming videos. Once you do hands-on, so you will get a better confidence on all these numbers. So as an exercise, you can take 2 companies, say Relaxo and Bata, from the same segment and calculate all the profitability ratios for these 2 companies and compare. And you can put the values in the comments below. So pro tip for investment is, for long-term investment, invest in asset-light model business, where the value of depreciation of asset is very less, where the change in inventory is also very less frequent. Asset-light business have higher PB ratio. For example, companies in software, marketing, digital marketing, the companies like TCS, HUL, InfoEdge. Till now, we covered profitability ratio and valuation ratios. Now in the upcoming videos, we will cover operating ratios as well as leverage ratios.
Please do like if you like the video and don't forget to subscribe to get the notifications of upcoming videos on personal finance and stock market. Please post your valuable comments. Do follow the Friday basics to make your stock market journey easy. Thanks for watching and have a good day.